In our last economic and financial markets video, dated January 6, 2016, we highlighted that market volatility was going to be a significant factor in 2016 and not to be surprised when the major indices dropped anywhere from 5 to 20%. Our forecast turned out to be pretty accurate as the S&P 500 index got off to its worst start in history, declining 11.5% in the first 28 trading days of the year. The record-setting decline was caused by renewed concerns over a material slowdown in China, sparking fears a global recession is now a real possibility. Adding to concerns of a global recession was a 20% decline in oil prices on worries demand was softening due to weakening economies around the globe. Just as investors began to panic and pulled nearly $5 billion from global stock funds, the Chinese government went on the offensive by explaining why their economic policy would bear fruit by mid-year. Then came along the European Central Bank, who put in place a major stimulus program that exceeded expectations. The final cherry on top was when the Federal Reserve confirmed interest rate hikes would be more gradual than originally forecast. All this added up to a perfect scenario as oversold shares caught a tailwind that gained steam with each passing day and eventually helped the S&P 500 index generate a 13.7% gain from the February lows. When it was all said and done, the S&P 500 index was up 1.4% for the quarter. The tech-heavy NASDAQ composite reversed course from last year and declined 2.8%. Small cap growth shares also reversed course from last year and lost 4.7% in the quarter, while international shares continued to struggle, losing over 3%. On a surprising note, emerging markets gained nearly 6% for the quarter as commodity prices may have found a bottom, creating optimism for the emerging market sector. So where do we go from here? While we at HM Capital Management expect volatility to continue, we do feel the degree of volatility will begin to subside. First quarter earnings, and perhaps more importantly, earnings guidance, will need to be strong to justify current price levels. We believe first quarter 2016 corporate earnings will in fact be good, and there is room for more upside in stock prices. However, please don't get complacent or overly optimistic. We maintain our forecast of 5 to 6% returns for the full year, which means markets have only 4 to 5% upside from current levels. HM Capital Management further believes the November elections and all that lead up to them will cause markets to pause and perhaps sell off as uncertainty can weigh heavily on financial markets. From the entire HM Capital Management team, thank you for watching.